Hi, guys, and welcome to another chat with traders. I'm here with Lance from Theta Traders, and right now we're making time in the late evening to get this chat out to you because we think it's going to be very valuable. My name is David Jaffee. I'm with the Best Stock Strategy channel. And Lance, if you can briefly introduce yourself, then that would be amazing.
Data traders with a Z, thedatatraders.com. Been option seller for a few years now. Been a trader for even longer than that. And I saw a lot of your previous videos in the last few years, and it looks like we have very similar methodologies for how do we think are some of the most optimal ways to be earning income, and pretty consistently. So definitely looking forward to speaking with you and looking at the different strategy that we both do, and possibly challenge ourselves and see where we might be able to stray a little bit. Because what's interesting about selling options is there's many different ways you could go about it. You could go really short DTEs, you go long DTEs, you could do them spreads, cash-secured puts, you could go futures. So should be a good conversation that we have.
And what I really like is you're from, and please correct me if I'm wrong, but you're actually a science teacher. That's your job, right? I believe you work like in upstate New York, and now you current.
So I did teach 1 year in upstate New York, but yeah, I'm currently in Texas actually. Yeah,
Where about in New York?
I live in New York. It's a really small town in the New York-Connecticut border. It was actually a school for dyslexia, and I was a science teacher there for 2 years.
Okay, what was the name of the not the school but like the town? Because I'm actually from.
New York-Connecticut border, about hour and a half from Massachusetts as well. Pretty much
Okay,
goes
cool.
north from there. Yeah, it's a really small town, maybe 40 minutes from Poughkeepsie, a little bit
Yeah,
more east and north.
yeah, I'm actually from the Catskills, so I'm from Monticello. So I'm only like an hour and like 15 minutes from like Poughkeepsie, Newburgh, like Orange County, Dutchess, etc. So I'm pretty familiar with the area. Um, One thing that I really like from from watching your video is, I'm sorry, what was that?
For camping, really close to Monticello, Liberty, and all that.
Oh yeah, Liberty. Yeah, it's if you ever drive next to Liberty on Route 17, you have to make sure that you don't go fast because the cops there they issue tickets. Like that's one of their main sources of income. Um, so yeah, one thing that I really like from watching your videos is we have like very similar styles where we're not the type of people who are like, oh, you're gonna make like 1% a day by trading options. Instead, we tend to preach slow and steady gains where we recognize that if you sell premium, your maximum amount of premium when you sell is the option premium that you actually collect. So there are some different ways where you can go long options in specific situations, especially like during times when you think like a position is like oversold or volatility is low, and therefore you can play the upside. But from watching your videos, what I really like is you also delve into like futures trading, and you're very big into like using scientific methods, like using a lot of what you teach as far as like being a science teacher into getting into like the statistics and things of that nature to optimize your trades.
Yeah, definitely agree. When you're looking at science, it's all about trying to solve the unknown, and it's pretty much a never-ending goal to try to figure out something. You might make some laws, and then they change over time because you find more information. It's very similar for different option selling strategies. You could try a certain strategy, look at what the expectation might be, and then it could play out the way that you, based on probabilities and statistics, could work out that way. Or sometimes with different conditions, it doesn't work with your probabilities. So you have to tweak it and then notice the different observations you can make, try a different hypothesis, and then try out a new strategy at times. That's why I do like paper trades quite a bit initially when you're starting a new strategy, especially so you can see the actual results, and you could do the results in a lot more data points if you're going on paper. So you can make multiple trades each day and then try to get your data more valuable so that you'll be able to see if it's a worthwhile strategy or not.
And do you use a lot of backtesting software as well?
Yeah, I've been using Option Omega a bit. That's They don't do stuff with futures, but you could do SPX options. You could look at different deltas, expirations, and it gets really detailed. You could even go day of the week and time that you're entering trades. Pretty much any type of stop loss or managing, and you could see the results in long time periods. So I have been using that a decent amount recently. I'm just curious about different strategies because even the day of the week could matter quite a bit, which I found pretty interesting because like you wouldn't think on a random Tuesday could be a better day to sell options for SPX than on a Thursday. And that's not
Oh, wow.
necessarily true. I'm just picking the random days of the week. But yeah, you can get pretty dramatic results, which is pretty alarming for me.
And how did you discover option selling and trading options? Did you have the typical arc as far as like you were always interested in the stock market? So you tried like potentially like day trading or like buy and hold or things of that nature, and then you looked for something that was more replicable and more of something that has a statistical edge, or how did you find out about options trading?
After college, or pretty much just bought index funds and I would buy some individual stocks, dividend growers, dividend achievers, and whatnot. Then eventually I had over 100 shares of certain dividend stocks. So I knew about covered call strategies, and I started with just really simple covered calls, pretty far out of the money, looking pretty far out in time too, 3, 6 months out. And it's a very conservative way to go. I think in general, it's a safer way to go than just buy and hold anyway, because at least you're taking in some premium and you are giving up some possible upside. But I was going for really small amounts, trying to go really far out of the money, far out in time. And that's how I started my journey because I figure if you could make almost the same amount in premiums as the dividends, and those dividends are growing over time, and then eventually with a solid dividend company, the stock price will go up. That was pretty much the first way that I started it. And it's a pretty linear path where I see a lot of from beginner, intermediate type traders. I started with that mostly, and then I got more into cash secured puts, still with those same dividend type companies. I look at basic support resistance. If it's near a support level, I might enter a cash secured put at that point, a little bit lower than that price to get a good entry point, and then just wheel strategy out from there. So that was the basics of what I did for quite a few years, and this was about 10 years ago.
You know, it's funny, there are so many hedge fund managers and retail traders who fail to beat the market, but the reality is if you wanted to keep things extremely simple, you could sell like a 2 to 3 day expiration, like in the money put on SPY right now, get assigned, collect that premium, and then sell like some pretty far out of the money call options, and then you'd basically be guaranteed like beating the market.
Yeah.
And it would be something that's very simple, which is something that many people they struggle with. So I think it's important to keep things pretty simple as well.
So, a lot of traders when we first hear about options, so feature notion can be very risky, but selling a deep out of the money covered call on a dividend stock is more conservative than just buying and holding in the end. So if you play your options correctly, you can make them even safer than just buy and hold, in my opinion.
Yeah, I agree. I agree.
Yeah.
What is so a little bit about my background. I grew up, like I said, in Monticello, and then I went to Cornell. I worked in investment banking, but I know that a lot of people think that Goldman Sachs and I didn't work at Goldman, even though I interviewed, but I wasn't given an offer there. But I don't think that necessarily working in investment banking provides me with any edge. In fact, I think from the opposite perspective, many people think that investment bankers or like institutional traders are like out to get, other people, or they're out to get like retail traders. And from my perspective, based upon like everything I saw, I felt like as investment bankers, like we don't really deal with the individual stocks. Like, yes, if if a company is trading richly with a very high PE, then we might put together a pitch book and encourage that company to issue additional shares via like a follow-on equity offering to take advantage of the rich premium that the market is affording their shares. But we're not there, like, and basically with with institutional traders, they make money based upon being market makers and matching up the bid ask spread differential or the risk free rate. or rather the risk-free premium that they're receiving by matching up buyers and sellers. So I
Mhm.
don't think that there's really any advantage. I do think, though, that experience matters. Whereas if you are going to decide, if you, as far as from the viewer's perspective, if you're going to decide to learn from someone who's like 20 years old, then I sometimes question whether that person has the necessary experience to go through like different market cycles, from a 2008 to a 2011 to like the flash crash and like, August 21st and 24th of 2015 to like COVID, etc. So I do think it is very important to gain experience and to learn from someone who has multiple experience in different market cycles. But I think that additionally, if someone is very passionate and committed to continuous improvement, then I think that that those type of people can be very successful by trading options as long as they mitigate their tail risk.
Yeah, I definitely agree with everything you said. A lot of the experience does come from doing a lot of paper trades, maybe entering 1, 2 contracts when you're first starting out and just getting pretty much those reps in, so to speak. Also, all these strategies we're doing, it's almost like the goal of perfection, but you're never going to be perfect in any particular strategy. I think the perfect is the enemy of the good. So obviously you do as well as you can, and then you tweak and go from there.
It's very funny that you mentioned that. I I think I've gotten into trouble by trying to be too perfect, where when we sell premium, you have a very high win rate, but then oftentimes there would be situations where I didn't want to accept a loss in the past, so then I would like add more put options because I felt that the stock was oversold, and then I actually lost more money because I wanted to quote unquote save a bad trade. And that kind of leads into the psychological predisposition of loss aversion. So one of the things that I've been doing over like the past 2 years or so, when I lost money, I had a bad position on PayPal, was to actually be loss seeking. So this year, I had just really like one trade where I lost a decent amount of money, but it was only about like 2 to 3 weeks worth of profits. It was with Dollar General. It was a few months ago. I think it might have been like July 1st when Dollar General reported and it had like the worst day for in like 14 years of trading. And in that situation, it dropped from I believe about like 185 to about like 160. And instead of fighting the trade and adding more options, I just immediately closed it out. I took a 2 to 3 week profit, and within that short time period, I was back to trading at a year-to-date high. So I do think it's really important to not try to be too perfect. And if you have a trade where the actual move ends up being significantly more than the expected move, then yeah, you can potentially, if it's on the put side, you can try to like sell some additional calls if you desire, because the in the money put has a much higher delta than the call options if you want to try to roll the in the money put. But oftentimes it's better just to close it out, lick your wounds, and then move on.
Yeah, that's pretty much how I treat almost every trade that I do. I'm just thinking about it as a large sample size and pretty mechanical on take profits and stopping out. Like I know you're following a lot more in the credit spread side, especially with the VIX being relatively low. And I would a few years ago I'd try to manage them, try to roll out in time, try to roll down. But now I'm just completely probability based. So if you look at, say, a point 0.1 delta put credit spread where you sell the point 0.1 delta put, it's approximately a 90% chance that that trade will work out. So that means that 10% of the time it won't. However, if you're taking in, say, 5% on your money in one trade and it works 90% of the time, it should be okay just losing 10% of the time I do a 3x stop, which is fairly common. So lose 15% of your particular trade in 10% of the time. But if you're making 5%, 90% of the time, the numbers are obviously going to work out in your favor. So it's just move on, lick your wounds, and then just take your next trade. That's pretty much how I follow a lot of these trades now.
I agree. It's be mechanical. And just for clarification, when you're saying that your stop is 3x, you're referring to the credit received, right? So if you received 50 cents, then you would actually have a stop loss at $2 because, or would it be a dollar 50?
We'll do $1.50 on the stop loss. So you only lose 2x of your premium. It's just 3 times the initial premium. So
Okay, so
you get
so you
50
would have
down to
a,
1.5.
I'm sorry, so just for clarification, your stop loss would be a 3x the credit received, so you would lose, so it would be a 2x loss on the initial premium, right? Okay.
Based on probability, if you're losing 2, the other time you're making your 1x, just keeping it simple, we're not closing early, we're just gonna let it expire worthless. If you're at a 66% win rate, you're pretty much broke even at that point, because the 2 wins would offset that 2x loss. But if you're doing 0.1 delta, you're gonna have close to a 90% win rate. It'll be a little bit less because you're stopping out early at the 3x stop compared to letting it go out. But from 90%, it's not gonna be much lower to 66%. So
Yeah.
again, it's almost like you're playing, dice, and then you have a dice that the one is going to come up a little bit more than the other numbers, and then you're just going to take those trades over and over because in the long term you have a positive expectancy at that point.
So I think a big takeaway here is, especially if you're a new trader, don't get caught up in having very high win rates. And I know that from my perspective, on the banner it says like win up to 98% of your trades because hey, you have to capture people's attention. But if you have a losing trade against you, have a plan where you're going to close out that trade for a loss. It's probably not worth spending a lot of time and resources and stress trying to manage and roll that position. You can a little bit if you believe in the underlying stock, but in my opinion, maybe 7 or 8 out of 10 times you're better off just simply closing it out and moving on.
I think that's one thing that we've both made in the past, and over allocate in any individual trade. So for my portfolio, I make sure that there's no more than 3% of my net liquidating value. That would be a stop loss. So just to keep the numbers simple, if I had a $10,000 account, I'm not going to lose more than $300 on any one position. So you could do the math there. It's a $50 credit initial, and then you're getting out at a 1.5 stop. You're going to lose $100. At that point, you wouldn't do more than 3 contracts for those numbers, because if you overloaded on the contracts and you stopped out there, you're going to be losing a bigger percent of your net liquidating value. So it's just constant trades, a lot of different trades, a lot of different sectors as well. Try to rotate them in, and then just play the probabilities out. And that's my main strategy for the stock-based trades, to be honest.
And what's your favorite or preferred trading strategy currently, and why?
I think currently it's with futures, and it's mostly on strangles and futures and 112 trade. It's similar to a Jade Lizard trade, where you buy a put debit spread, and then you sell 2. You can also sell 1 or sell 2 puts that are naked against the futures contracts. I really like futures because of span margin. Like if you did just a basic strangle on SPY, it's going to be quite a bit of funds that you're going to need. Just Reg T, you're looking at $40,000 or so. Portfolio margin, you're a fraction of that. But if you sold just an MES strangle, you could do those for a few $100s, even bless you. But you're using a pretty large notional value. It's just that span margin's using a lot less funds. So like primarily I'm trying to grow futures accounts at this point.
So for the viewer, span margin is very comparable to portfolio margin, and portfolio margin is offered for larger accounts by the brokerages. Usually if you have around $150,000 in your account, sometimes they make you pass a test. I know that E-Trade does. Others like Tastyworks or Tasty Trade, I think that they enable it if you ask them to. But span margin is great if you have a smaller account because it provides significant leverage. I actually, so for futures, do you trade naked or do you trade spreads?
Pretty much only do naked. The put-to strategy, it does have a put debit spread. We're actually paying a debit for that hedge. Then I'm selling 2 naked puts over it. I've noticed doing spreads on futures hasn't really been much benefit. Like if you do an ES like 50 whip spread, like credit spread, and then you compare that to just an SPX 50 with, it's going to be pretty much the same in buying power. If anything, you're actually paying slightly more in commissions with the futures, and you're not really gaining much on the span margin for that. So that's why I don't really do many in spreads, but the buying power again is very important. I want to make sure we're not more than 3% of your net lick that we're going to possibly lose. So if it was like a GC or gold strangle and the stop loss is more than that 3%, I would make it an iron condor in that case. So then I'm lowering the total premium that I'm initially taking in, knowing that the stop loss would not be 3% of my account. And I prefer strangles over the condors if possible. But again, if you have a smaller account, I think it's more important to make sure that you're risking your, no more than your 3% of your net lick anyway.
And what broker are you using?
I'm using Tasty Trade. Tasty Trade and Thinkorswim are both relatively good with futures, but Thinkorswim, the commissions are almost double than Tasty Trade, because in Tasty Trade, they don't charge commissions for closing them. They do charge the fees, but that's just part of the clearing. But Thinkorswim does charge for the closing of those. So Tasty Trade has been preferred just based on the commission structure.
How much are you paying for every like ES or MES future contract? Is it like $2 like total? Because I know that you have the commissions from the broker, then you have the options commission.
Forgot in the ballpark, it's around $4.50 or so for a strangle. So that's including the closing. I think it might be another dollar or so to close it out. So about $5-6 for MES. ES would be a little bit more, about I think $7 or $8 total. And then some of the commodities like gold, oil, corn, they are slightly more, maybe because they're in a different like commodity market or something. But yeah, Tasty Trade is probably preferred there. Some people use interactive brokers as well.
Okay.
But I've noticed that interactive brokers does use more in margin requirements for your span margin compared to Tasty Trade. So you could use a lot less of your buying power in Tasty Trade for most of the trades that I've compared. So
Okay, awesome. Russell actually sent me an example of the 112 trade, and I put one of them on. I really like it because it actually provides protection for some of the 0 and 1 DTE trades that I put on, because with the 0 and 1 DTE, well, rather with the 1 DTE, you have overnight risk, but with the 112, there's actually like a donut between the long put and the short put, where you can actually profit based upon the entire wick. Now, I know that you're financing it with a put option that's about 20% below the current market price with multiples of those in order to get a credit when putting that on. But I think that that trade is incredible because it provides you with an opportunity where if the market has like anywhere from a 5 to 10% pullback, you can actually profit tremendously from the difference between where you bought the option and the debit, and that long option, or rather the short option that you sold from the debit spread.
exactly. And you said you're doing more of the recent about 1-2 DTEs on these.
Yeah, so I'm using the 112s as overnight risk protection for some of like the 1 DTE trades. It just provides like, now I have like long-term hedges on as well, which provide additional, but it definitely balances out some of the gap risk, like the overnight gap risk, where hey, if the market opens up like 150 points lower, then from the 112, I'll actually make money and profit from that as well.
Yeah, I prefer longer dated expirations on these, and you could actually get pretty good returns. I know both of our goals is approximately 2-3% a month on our trades, and you could even go as far as 120 days out and then sell the 112 where your naked puts are really far out of the money. We're looking at 18-20% out of the money on an SPX contract. So having that naked put usually closes out within around 90 days or so, but you're going to be taking in about 10-11% of your total buying power in the trade. So you're still making your 3% or so, and that includes the hedge where you have your PDS still intact. So that's a 10% even paying for the hedge. And then obviously the hedge hits, you can make 25-30% on your money in about 3 months. So I'll be interested in looking more into the shorter term, like the 1-2 DTE. You're saying you're using it more as a hedge for your other positions, is that correct?
Yeah, exactly. Right.
Okay, yeah, that's definitely something to consider. I've been using occasional iron flies for a hedge, especially if the market's been dropping a lot. I'll just buy a hedge for probably 5-6% in about a week out, just to see like if it happens to hit, it's going to pay off a lot. If it doesn't hit, then my other trades were good anyway, because you obviously made your trade.
And what are some mistakes that you see new traders make?
A lot of it has to do with the amount that they're putting into individual trades. So again, some people are seeing a few trades, it's working out for them, and then they go overboard and they do way too many contracts in one position, and then they either stop out, but then they're significantly hurting their account, or they decide to hold on to it longer, and then it could possibly exacerbate the losses. That's a pretty common one I'm seeing. What have you seen a lot from beginners?
I think that they try to take too much risk and they try to turn like $2,000 into like 25,000 or 2,000 into like 50,000. They trade too many contracts. And additionally, they trade underlying securities that are more like meme stocks. And they kind of get confused, or not necessarily confused, but they get distracted from shiny object syndrome.
Yeah.
And those are the primary mistakes that I see new traders make.
Yeah, I see those questions come up all the time where I'm giving my recommendations, and then I'll see people, what do you think about so and so meme stock? And then, I'm going to say my advice. It might work out, and there's a good chance it could if you're going really low delta, but you could easily lose quite a bit of money, especially if it goes against you with those high IV positions. I used to do a few of those, like selling category puts on AMC and things like that. And then it just wasn't worth the risks anymore. I'd just rather stay with the futures, stay with ES, oil, gold, commodities. And then it's a little bit more diversified, obviously. The implied volatility is typically much lower, but you can still make your good returns and make your goals.
I agree. So two more questions. You
Okay.
briefly spoke about like hedging, and are you using the 112 as a hedge, or are you using other means of hedging? And can you,
Today, actually, I closed one of my 112s. It had about 50 days left, but I was able to take in about 8% on my overall trade by getting rid of the naked puts. I left the hedge on, and it was at around 4,200, 4,150. So it still has a way to go to get to the hedge, but I took my risk off the table there because I already made my target profit. And then there's not really much reason to close the hedge. So you might as well just leave it on. And there's a chance that it pays off or a chance it doesn't. But what's good about it is if the market keeps dropping, that hedge will cushion the blow a bit.
right,
So your fan margin won't increase as dramatically as if you didn't have it. So you might as well just leave it on.
yeah. For me, I primarily buy long-term SPX options, especially during periods when VIX is trading below 15. Additionally, I have looked into buying VIX calls, like long-term dated and leaps for VIX calls, especially when VIX is trading under 15, or even under 14. I think it's currently trading at around 14 or so.
Yeah.
And what are your thoughts regarding zero DTE?
So 0DTE, I still do these trades, but I'm using a much lower allocation because I don't like the big swings that could happen in your account. Typical trade is taking in about 2.5, 3% for the day. I might close it out at 0.5%, so make about 2% on the day. But the stop outs would be, triple that, maybe 4, 6%. And then you just have big swings in your portfolio if you do a large account size of those trades. So I still do occasional ones just to monitor and help my members out, but it's pretty small percent compared to everything else that I'm doing. What are your thoughts on the 0DTE?
I like 0 and 1 DTE. The thing is that I go very far out of the money. And I do think that, especially for retail traders, it's very important that reach out to their broker and that they negotiate very low commissions. Because especially if you're doing like iron condors on SPX, then that can get very expensive, and the commissions alone can actually make it so that it's not profitable. So I think that it's fine, especially if you have ways of mitigating your tail risk, either by buying long-term put options or using a structure similar to the 112, where you can effectively negate and mitigate out the tail risk, or not necessarily the tail risk, but the gap risk, like the overnight gap risk that you have. And yeah, as long as you negotiate your commissions, then I think that it's okay, as long as you also close out your trades that are not winners at about a 3x credit received.
Exactly. Unfortunately, today we actually got stopped out, but I stick to my mechanical rules. I just sold a put credit spread and the market dropped a lot right at 9 o'clock. And I stopped out even though the trade would have worked out. It's again just probabilities. I know the next one will just go with the probabilities and just move on. A lot of issues I also see with beginning traders is they overthink and they get the emotional distress of getting a stop out. And it's really not the end of the world. So some people are like, every trade must work. And if it doesn't, the end of the world is collapsing. That's not true. Just move on. Like, just like a lot of day traders, if you're buying options and buying, penny stocks, some people, they'll just take a certain amount of loss for the day and they stop for the day. Like they're not going to keep going because you could have a lot of emotional issues after that. And then you try to make your losers back, you kind of losing a lot more. So there's a lot of traders that I know where the firm that they work at, they'll close them out. You're like, you're done for the day, go to the beach, because you're probably not in the right mindset to make trades out there.
I agree. All right, guys, thank you so much for joining us on this chat with traders with Lance. I'm going to link to his YouTube channel in the description and also in the pinned comment below. And I believe he'll do the same when he posts it on his channel as well. If you have any questions for us, then please leave a comment below. Lance is someone that I really love his content. He's coming from a scientific background. As you can tell, he's very intelligent, and he does back tests, and he has a very statistical, probabilistic trading style. So I highly recommend it. And Lance, do you have any parting words?
It's a great conversation we had, David, as well. We have a lot of similar ideas on how to actually use options to sell in order to make money. And it was a really good conversation. I'd like to talk further, maybe off record to see, or we could do another one on record if you'd like, just to have some other ideas, because these are really interesting talks.
Sure, I'm open to that. All right,
Sounds
guys,
good.
thanks again, and enjoy the rest of your night.
Have a good night.
All righty. So